What's going on, ladies and gentlemen? We're going to talk about Ken Griffin versus Donald Trump and why Ken Griffin is pissed off at Donald Trump. I don't think Trump likes him very much. This one's also going to be about Elon Musk, Donald Trump, Ken Griffin, hedge fund traders going to federal fuck-me-in-the-ass prison, MMTLP, MMAT, Torchlight, GameStop, AMC. Let's go. Live stream number 2 for today. Technically number 3, but one of them had an audio problem, so here we go, ladies and gentlemen. I'm going to give it just 2 or 3 minutes to let more people join in, so let's do that.
I want to be clear, I do not respect the SEC.
We made the decision in the morning to limit the buying of about 13 securities on our platform. So we're really in unprecedented times. In order to protect the firm, we had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Sam Bankman-Fried and FTX, he's been charged by US courts and the SEC with money laundering, conspiracy to commit wire fraud, and securities fraud for the collapse of FTX. The former chairman of NASDAQ, Bernie Madoff, built the largest Ponzi scheme in history. Over 4 decades, he faked records of annual gains to investors who thought he was investing their funds, when in fact, he was just using new investor capital to pay off older investors.
But the synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts, and I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this.
Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources.
I basically would like to ask the SEC why they didn't act on the morning of January 28th, because I was so scared, I can't tell you how scared I was. I was so scared, I can't tell you how scared I was.
Well, Thomas, what were you scared about? What does failure look like? You said we came close to breaking. What were you scared of?
I was scared of a domino bankruptcy. I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly it didn't go further, but it could have gone further.
So buying and selling those 200 shares would make the market maker $1. But as millions of shares are traded, the profits from the spread add up. In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow.
Disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I really ask staff to consider that, but also to consider it only in the context of the entire market structure.
On January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities imposed temporary trading restrictions on certain securities. Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements.
The decision to restrict trading really was internal to Robinhood. We did not have discussions about that.
Like GameStop, AMC, all these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in the small cap market and is very much a problem.
Has your husband ever made a stock purchase or sale based on information you've received from you?
No, absolutely not. Okay, thank you. Thank you.
Those are fully collateralized tokens.
That markets are efficient because of active managers setting the prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
It's definitely not receiving the benefit of the broader competition for markets. A lot of people think that Ken Griffin is working very closely with Donald Trump. And I beg to differ. From what I'm seeing here, Ken Griffin is really pissed off that Donald Trump has chosen J.D. Vance as his vice president. I've shown you guys multiple videos in which Citadel Securities, the market maker and hedge fund, founder and owner Ken Griffin has been talking very negatively about Donald Trump. And we're seeing something fairly similar right now. And he's really pissed off that the senator who signed the letter for the United States Senate to the chair of the SEC, Gary Gensler, in regards to the MMTLP, basically FINRA trading halt that occurred, what many people believe to be too early. This guy is not exactly best friends with Wall Street, and neither is Donald Trump. So let's talk about that briefly. As you guys can see, before I get into that really quick, Elon Musk has confirmed that he's going to commit $45 million per month to back Donald Trump in order to get his super PAC to elect President Trump. And for this, I have to say thank you to Elon Musk, as well as for freeing people from the massive far left liberal Twitter that used to be the case and is no longer. So, Republican megadonor Ken Griffin's team conveyed to Donald Trump that they did not want the Ohio senator. Multiple people, as a matter of fact, have been saying that they don't want J.D. Vance to be the vice president. Murdoch, formerly of News Corp chief executive, also weighed in with Trump and made it clear that he supported other prospects. That's the New York Post, the Wall Street Journal, Ken Griffin, and Citadel are all now upset about the choosing of J.D. Vance as the vice president. So his opposition presented a big challenge for Donald Trump and other contenders that have deep relations with mainstream donors like Ken Griffin were not chosen, even though they were, as you can see here, eager to undercut Vance. So even Kellyanne Conway, who was the 2016 campaign manager for Donald Trump, repeatedly conveyed to the future President Trump that J.D. Vance was not someone that she wanted to be the vice president. And basically, too fucking bad. You know, what we saw with MMTLP was potentially something that was very similar to what would have happened with GameStop, to what happened with GameStop and AMC stock in January of 2021, June of 2021. And you guys even saw it happen about 8 weeks ago at this point, back in June. So not even that long ago. May and June, I should say. So, as you guys can see here, in January of 2021, the NSCC provided to Robinhood through an automated portal the largest components of the company's collateral deposit requirements. And that was their value at risk charge. That basically means a margin call. Robinhood was margin called by the NSCC for $250 million related to GameStop stock exposure and $850 million for AMC stock exposure. That is a margin requirement of $1.3 billion and a Dodd-Frank risk deterrent amount of $2.2 billion. So Robinhood calculated that of the $1.3 billion value at risk charge that they had, approximately $850 million was attributable to AMC, and approximately $250 million was attributable to GameStop. The reason for this, there are more retail investors in AMC than GameStop, essentially making it even more dangerous to hedge funds than GameStop ever was, regardless of the share price. At the time, GameStop was worth more by market cap and by per share than AMC, and that is similar to today. Regardless, you guys can see the numbers right there from the House Financial Services Committee. At the same time, J.D. Vance is the one that has written this to Congress. Not written this, signed this for Congress. Okay, and if you guys are unfamiliar with MMTLP, here's the quick short story. There was a company named MMAT, was the ticker. Metamaterials was the name, formerly known as Torchlight. They filed a prospectus in July of 2020. It was originally tied to an SEC Form S-3 filing in September of 2017. There was an investment bank involved called the Roth Capital Partners. And Metamaterials is basically an advanced material and nanotech company. They hold over 500 patents as of July 2024, and they're developing materials that can manipulate light, sound, and electromagnetic waves. And these could revolutionize a variety of industries from telecommunications, aerospace, and healthcare. Imagine your smartphone charging wirelessly from across the room without having to plug it in. Your smartphone, as long as it's within range, it could charge. Aerospace, all sorts of amazing different kind of materials that could be created there for all sorts of diffusion of heat and God knows what else. And healthcare. I won't even get into the healthcare possibilities because there's so many. So basically, John Berta was the president and CEO of Torchlight until 2020, and then George Pelikaris became the CEO beginning July of 2021 after Torchlight merged into Metamaterials, MMAT. After the merger, Torchlight issued a dividend as a preferred stock dividend under the symbol MMTLP. It was not actually a stock, but it was a stock dividend placeholder, and it was never meant to be publicly traded on public markets. So it ended up in the OTC as pink sheet. It is gray market pink sheet OTC non-tradable garbage that market makers used a legal loophole to trade. Yes, it was legal to make it trade. So after the merger of Torchlight into MMAT, thus creating this MMTLP stock that should have never been traded. Again, it was never really a stock. It was just a dividend placeholder. Metamaterials is currently embroiled in a class action lawsuit after FINRA ordered a U3 halt that prevented long shareholders from selling their stock. It prevented shorts from closing their short positions, and all of this took place exactly 1 day before closing for the spin-off of NextBridge Hydrocarbons, which was to be the subsidiary of Metamaterials, MMAT. I know it sounds a little convoluted, and it is, but that is why this is so important. So as you can see here, this United States Senate letter dated September 26th, 2023 states as such. They were writing the SEC to examine events surrounding the trading halt of MMAT and, of course, MMTLP, the Series A preferred shares. As noted by our House counterparts on July 28th of 23, MMTLP shares began trading on the OTC market in 2021. In 2022, the SEC approved a Form S-1 and amendments to spin off a portion of the company. So currently, MMAT and NextBridge Hydrocarbons are two separate companies, for those of you that are unaware. On December 9th of 2022, FINRA issued a trading halt on the company's stock, preventing shareholders from making trades. This means people were no longer able to buy, people were no longer able to sell, and shorts were no longer able to close their positions. In the FAQ from FINRA regarding the MMTLP corporate action and trading halt, it's noted that NextBridge hydrocarbon shares would be distributed to shareholders of MMTLP with settled positions as of December 12th. And FINRA halted trading on December 9th because securities transactions typically must settle within 2 business days in accordance with SEC rules. But since December's events, investors across the country struggled to gain clarity regarding both the spin-off transaction and the halt on trading. Therefore, they said that they echo the House counterparts and request that the SEC review these events. So as you can see here from this letter, Mike Crapo and J.D. Vance actually took the time to write to Chair Gensler of the Securities Exchange Commission from the United States Senate and actually signed them personally in order to stand up for retail investors specifically. Now, you've heard me cover this on this channel in the past. If you've been subscribed here for several years, we were telling people that MMTLP was a very bad investment, even though it's not financial advice. It was a very bad investment to buy into in hopes of a short squeeze because it was never a real stock. It should have never been traded. It was a dividend placeholder. It was OTC, pink sheet, gray market. You get the idea. And we told people that you are very likely to be chasing something here that is not going to do you any good unless you want this NextBridge hydrocarbons spin-off. And that could potentially make you some money in the long-term future, but it would take multiple years. And that's only if NextBridge hydrocarbons actually IPOs in the future. So we told people that that would be a massively long hold, and there's a potential for a lot of people to lose a lot of money. Sadly, I believe the number is around 62,000 people, 62,000 investors in MMTLP were not able to sell their shares because FINRA halted trading 2 days prior than they actually were supposed to. They were supposed to halt trading as of December 12th, and they actually did it on the 9th without warning. So they really committed a fairly nefarious act there, whether willing or unwilling, whether they knowingly did it or unknowingly did it, in the sense that if they expected that many people to try to be piling into MMTLP, that's unknown. But the reality of the matter is that what occurred there with MMTLP, even though shorts were using it as a way to short the parent company stock, MMAT, and hide those short positions, people expected, sadly, that MMTLP would have to, that the shorts would have to close their positions in MMTLP. And at the same time, we've heard multiple brokerages now. You guys have heard this, has seen this on my channel. I'll pull it up now. Multiple brokerages have insufficient shares to complete the dividend. Check this out here. TradeStation doesn't have sufficient shares to complete the MMTLP to NBH dividend. Retail is beyond upset at what happened here, and with good reason. This is not just a stockbroker problem. This is a systemic issue, a massive systemic issue here. Or the DTC and FINRA issue that affects all shareholders, right? So we need a complete overhaul of the financial sector: stocks, crypto, bonds, ETFs, derivatives, swaps, naked shorts, synthetic shares, treasuries, the whole fucking lot of them. And at the same time, TradeStation here is basically admitted to having an insufficient amount of shares, as you guys can see here. There are synthetic shares in MMAT, MMTLP, and as a byproduct, even the now private NextBridge hydrocarbons. And it was simply a dividend placeholder that should have never been allowed to trade, but it was because there was a legal loophole allowing them to do so. Here, as you can see, somebody reached out to TradeStation, and they literally told them, at this time, TradeStation has sent the majority of its original certificated shares to AST to be held on their books. There is a de minimis amount of shares remaining in the current certificate, and therefore new requests cannot be accepted until a time when TradeStation receives new certificates of owed shares or NextBridge hydrocarbon shares become tradable in the open market. Or again, NBH is a private company and they don't trade, they're not IPO'd, they don't trade on the New York Stock Exchange or OTC or anything of the sort. So this guy asked, so TradeStation doesn't actually own any shares of NBH on their books currently, but has taken $3,000+ from my account. For what exactly, if you don't have a security backing it? They said, due to the physical certificate being produced as of a specific record date position and fully paid loans being active on that record date, TradeStation was allocated less shares than the firm's overall customer position. Now, for those of you that don't speak this idiocy of, convoluted New York Stock Exchange lingo, it basically means that they did not have sufficient shares because TradeStation, the broker-dealer, the stock brokerage firm, lent out a ton of shares, likely more than they had on their books. They were lending out shares that they didn't have to shorts without actually having a way to locate them. And then this guy follows up by saying, you just said right this second that you have less shares than customers' positions. So please confirm to me what I used my $3,000 to purchase for on my cash account if you didn't go to the market to purchase these securities. You took my money and purchased nothing. I want to speak to a compliance manager. No. Of course, they said, we didn't take your money because they gave your money to the market makers, right? So, and then TradeStation lent out shares, more shares than they should have, and they never received enough shares to give people their NBH private equity NextBridge hydrocarbon shares. This is a systemic risk that very likely could have been a situation just like AMC and GameStop in the past. But FINRA prevented that from happening by making by basically halting trades on the stock of MMTLP, which FINRA should have never actually let trade in the first place. So I'll let you guys dwell on that, and you guys are probably wondering, well, why was it more done about it? It is what it is. That's a big problem there. More should have been done about it sooner. And as some of you guys may have seen earlier, this is a consistent issue in the markets. And just as if you saw my live stream earlier, a former hedge fund trader has been sentenced to 3.5 years in federal fuck-me-in-the-ass prison and been ordered to pay $215.8 million in restitution for using his hedge fund, 8 hedge funds actually, to pump and dump the same type of OTC, pink sheet, gray market, penny stock garbage that they were manipulating via cross-trading, spoofing, rehypothecations. They did the exact same things to these other stocks in the OTC than they did to MMTLP. And they had to pay $215.8 million in restitution. Well, I want to know one thing. Where's the fucking restitution for MMTLP holders? Where's the restitution for MMAT holders? And NextBridge Hydrocarbons and Torchlight. All of these 3 separate companies technically. Right here, there was a $440 million fraudulent portfolio pump happening between the shares that were traded at inflated prices to these firms via their 8 offshore hedge funds. Where? Of course, in the Cayman Islands. And the owner of this place, and Hetherington, the guy who was sentenced to 3.5 years, was looking at 25 years. But of course, these pricks will always turn on each other, and he turned on his boss of Absolute Capital Management. But of course, the guy was indicted in 2013, 5 years before this indictment even occurred, on securities fraud and wire fraud charges. He was arrested in Italy, fled to Germany, and he remains a fugitive per the federal prosecutor's office. So of course, Hetherington, even though he cooperated with them, gave up somebody who is on the run anyway, and was still ordered to pay $216 million in restitution, along with several co-defendants, Todd Fischetto, former stockbroker who was also convicted in the case. He was sentenced to 6 years in prison in 2020 after being found guilty of 18 felonies relating to his role in this scam. This is not an old article either. This is from July 15th, 2024. This is new information that we are finding out about what is going on in these sorts of scams in financial markets. And this happened with a broker-dealer that they co-owned together. We're sick and tired of what's going on in these markets, and that's why we've created livestreams.com. We are a fintech firm who is creating a stock brokerage and crypto brokerage that is actually out to help lit markets. Go to litexchange.com. There is no E at the beginning of exchange. You guys can sign up for further information, and it is going to give you the opportunity to own equity in the company so that when we IPO, you will be able to see and sell your shares on the market. Of course, this comes with risk, as any investment. You guys will be able to find all of our information on the SEC Edgar website and on our funding portal website as well. So I'll give you guys that information later next week. I wish you all peace and wealth. I see all your chats. I just don't have the ability to reply to all of them, but I'll reply to one. Walter says, you're discussing important issues. Would you evaluate a ticker from today and give your opinion on shorts and synthetic shares? Do they naked short, then create synthetic shares to close profits? Then there is often a direct correlation between synthetic shares and naked shorts, my friend. I do not know which exactly share is synthetic and which is naked shorted, of course, because I'm not the DTC and I don't have access to that. But there are often failures to deliver that come from naked shorting. Naked shorting leads to failures to deliver. And failures to deliver are often closed out via the use of synthetic shares created by what we call as the liquidity fairy. These liquidity fairies are the market makers. The market makers have exemption rule 203B that allows them to naked short companies without any shares. And that is basically creating synthetic shares out of nothing and diluting the stock price. That is one of the major issues that we're currently seeing. And because of that, many stocks out there are not actually reflecting their actual value when they have the ability to naked short stocks like GameStop, AMC, MMAT, and create OTC shares out of something that is simply a dividend placeholder like they did with MMTLP, or to trade OTC garbage and pump and dump people's pensions and 401ks and investments in hedge funds. It creates a serious problem in financial markets in their entirety. So, ladies and gentlemen, I wish you peace and wealth. I see you asking for the Discord. I'll drop the Discord in the comments.